In today's episode of the KVKurious Podcast, we have an extremely special guest. It's Professor Subramanian, who's currently the Executive Director at IMF, Executive Director of India at IMF. And previously, he was the Chief Economic Advisor of India. He's also a professor at the Indian School of Business. This conversation touches upon a multitude of things, from why is money a zero-sum game, why or how is wealth created, CBDCs versus cryptocurrencies, how do you go about policy making, budgeting, and many more things. So I encourage you to listen to this conversation completely. Hope you enjoy this. Stay tuned on the KVKurious Podcast. Hi, Professor Subramanian. It's quite a privilege for me to host KVS on the KVK show. So thanks for making it today to this conversation, and looking forward to discuss some money, banking, decentralization, and cross-border payments and more stuff with you. Thank you for being here.
Thanks for inviting me.
Okay. So I was reading about your book, Money is a Zero-Sum Game. And one thing that I noticed you mentioned explicitly was the banking sector is perhaps more critical to the economy than the central banks itself. And this is primarily because banks tend to have the power to issue debt, and theoretically infinite debt. So then why is it that we need, so many number of banks in the country? Alternatively, why do you have to limit the number of banks, and why can you not just let independent people or individual small clusters or lending organizations themselves function as banks, allowing them to theoretically issue infinite debt?
Good question. So I think first let's understand why is it that banks are considered to be, to be having the ability to create money ex nihilo. That's essentially a Latin phrase for the fact that they can create out of nothing. So the first thing to understand is, and this relates to your question. So suppose, let's say, I were to ask you to lend me, 1 lakh rupees, let's say, right? Now, what would you do? You would be able to, lend me that 1 lakh rupees only if you yourself have 1 lakh in your, in your bank account. So if you have that 1 lakh, you can transfer that 1 lakh to me. That's essentially a loan. So what you are essentially doing is you're passing the parcel in some sense. You had that parcel of 1 lakh, and you passed me that parcel, which is what essentially happens, because it's just if you think about what the bank would do, bank would debit your bank account by 1 lakh and credit mine with
it's a ledger
1 lakh.
entry. Yeah,
so it's a ledger entry, which is essentially, and that is just passing the parcel. That's how money lenders as well. If money lenders were to lend to, they can only lend what they have. They cannot lend beyond that. But this is where the banks are different, and banks are in fact actually different from NBFCs as well, non-banking financing companies too, because banks, the way they function is so when I approach, let's say, a bank, if suppose I approach ICICI Bank for the same 1 lakh rupee loan that I asked you for, now what ICICI will do is ICICI will essentially, assess my worthiness, my credit worthiness to be actually receiving a loan, which is they'll assess whether I have the ability to repay and the willingness to repay the loan. Those are the only two things that they actually are bothered about. If they think that, I have the ability to repay and the willingness to repay as well, then what they will do is they will, they'll sanction the loan. And when they do that, they credit my bank account, with 1 lakh rupees. But at the same time, what has also happened is, they've actually given me a loan. So if you look at my balance sheet, my liability has increased by 1 lakh because I have a loan. But at the same time, my asset has also increased by 1 lakh because I have a deposit amount of 1 lakh, right? Now, look at the, the mirror image of this basically on the balance sheet of the bank. For the bank, what has happened is their asset has increased because the loan is an asset for them. So that has increased by 1 lakh. But at the same time, their deposits have increased, and deposits essentially are a liability for them. It has increased by 1 lakh. So as you can see here, in this case, because banks have to, and this is a partial, partial reason for why banks can actually create ex nihilo, is that when their total liabilities increases by 1 lakh, they have to keep reserves, bank reserves of only 4%, and that's based on the cash reserve ratio. So of the 1 lakh, if they keep 4,000 rupees, that's more than enough as bank reserves with a central bank. Now this feature where the central bank is essentially the lender of last resort is allowing banks to therefore keep some portion as reserves and then lend money, is not there with any other entity. Whether it's a money lender, whether it's an NBFC, peer-to-peer lending, none of these have this feature where the central bank essentially is a lender of last resort to the bank. And that is therefore very important to understand why you can't have anybody creating a bank, because firstly they have to have some net worth. What if, suppose let's say all the loans that they've given, suppose they don't they don't get repaid, or a large majority of those loans do not get repaid, what will happen? Obviously the bank has to take a loss, right? And when the loss happens, what the net worth or the equity of the bank essentially has to decline, because if they have to make do their depositors in the amounts that they have taken, the deposits, then they have to tap into their net worth. And that is why the bank regulation across the world requires bank regulation across the world requires the banks to have at least some minimum net worth. For instance, in India, it's 500 crores if I remember right. So now that is because up till 500 crores of losses on their loans, they can make do. In fact, not just that, far more, because if they have the Reserve Bank as the lender of last resort, the bank, much like the banks can essentially lend ex nihilo, in a similar way, central banks can also lend to banks, and that is what you have is reserves. Bank reserves is essentially a transaction between banks and the central bank. So that is why banks are unique, and no other entity has this ability to create money. So here, if you see, it is actually, as I explained, it's a loan that is created, not the deposit creating the loan. In the case of money lenders, etc., or a peer-to-peer lending, unless you have the deposit amount, actually you cannot do the lending. But that's not the case with banks. Plus, when you take into account the overall money supply in the economy, money supply is comprised of essentially the deposits and the cash that we carry in our pockets, of which about 90% of is, if you look at the money supply in the economy, 90% of it is bank deposits. The cash is much smaller. So you can see, therefore, which is the elephant in the room that is creating money in the economy. It is actually banks. Okay. So now let me, come to your question about why can't you have, why can't you have just one bank? I've answered why you can't have any number of banks. Any Tom, Dick, and Harry cannot go and open a bank, because they may not have the ability to repay depositors, and some minimum net worth is required. That is why you can't have banks proliferating. And the power that banks have actually in being able to create money ex nihilo like this, peer-to-peer lending cannot, money lenders cannot, NBFCs cannot. Reason you actually don't want one bank in the economy is pure and simple, which is that economics teaches us that any monopoly will lead to abuse of power, and in contrast, competition is good. So what will happen if you have only one bank in the economy? The bank will, because bank has all the power, they may charge a very high interest rate because there is nobody to to challenge them. In contrast, if you have multiple banks, I, let's say, go to State Bank of India, and State Bank of India says that we'll give you that 1 lakh loan, but we'll charge you a 15% rate of interest. I then go to ICICI Bank, and ICICI Bank says, no, I know, we'll lend you at 10%. So, now that if State Bank of India knows that, look, they actually are losing business because they're charging it at 15%, they will reduce the price of that loan. They'll basically say, okay, I'll give you at 10% as well. And that is the effect of competition in the banking sector, which is why you need enough number of banks in the economy so that there is competition. But you shouldn't allow Tom, Dick, and Harry to actually create a bank, because they wouldn't have the net worth to be able to actually take losses that might happen if some of the loans are not repaid.
Got it. I understand why you cannot have a single bank, but then a counter question to why you cannot allow any lending institution to sort of become a bank. So if you take a conventional bank today, be it a public sector or a private sector bank that typically has net worth above 500 crores, that has a banking license, it is very well possible that even these banks have situations where a huge sum of money is not repaid. In which case, the way they bail out themselves is by taking debt from another bank, and another bank has the ability to issue more debt because that's what banks are supposed to do. Now, theoretically, if every bank were to mess up, and if, let's say, every person who took a debt messed up and did not repay, RBI is able to still, or any central bank is able to still bail out all these folks, because there is a certain amount, for the lack of a better word, insured through bonds that an equivalent amount of which can be used to bail out these banks. But am I right in saying that that number is finite, or can it be infinite?
What number is finite?
The amount of debt that RBI can bail out these banks with.
Okay, so here's that you are talking about two different things here. One is you're talking about deposit insurance. Deposit insurance is actually not done by RBI. It is done by the Deposit Insurance Corporation of India. Where what banks do is, much like we, when we buy life insurance or, let's say, property insurance, we pay an insurance premium, right? And that insurance premium is commensurate to the amount of insurance we buy. In a similar way, banks also actually buy insurance, with the Deposit Insurance Corporation of India. And, if there is actually, so what they're doing is they're essentially insuring their deposits. So that part is, now that part is, of course, finite, because how much amount the bank has insured on the deposits and the premium that they're paying, that is basically what they can be insured up to. But the Reserve Bank of India, Reserve Bank of India, as the lender of last resort, has infinite resources to be able to take care of banks, and that is why the Reserve Bank of India is called the lender of last resort. So, here are a couple of important things let's understand conceptually. See, if we look at the, money in any economy, there are three kinds of money in any economy. Okay. One, we just spoke about, currency. We spoke about bank deposits, and we also, so bank deposits are the second form of currency, and bank reserves is the third form of currency. So your currency, which is the what you carry in your pocket, your bank deposits, and your and reserves. Now, understand that each one of this is essentially an IOU. It is just an IOU. If you take currency, it is an IOU that is signed by the governor, saying that if you're holding a 2,000 rupee note, it basically says, I owe you 2,000 rupees. That is what the RBI governor is actually promising. It's an asset for me. If I'm holding that 2,000 rupees in my pocket, it's a liability for the Reserve Bank of India. If I next take bank deposits, suppose I have a 1 lakh bank deposit with State Bank of India, then it is again an IOU, because it's just an accounting entry. So State Bank of India owes me 1 lakh, and I actually have the asset of 1 lakh. So it's an asset of 1 lakh for me, liability of 1 lakh for the State Bank of India. And the third one, which is bank reserves, these are basically nothing but deposits that banks themselves, keep with the Reserve Bank of India. So it is essentially an IOU, written by the Reserve Bank of India to the banks. Okay, so it's an asset for the banks and a liability for the Reserve Bank of India. Now, here's where the lender of last resort function essentially will work through reserves. Firstly, central banks are very well capitalized, in sound economies. Central banks are generally sort of, equivalent of a AAA rating, where, they have adequate, capital. So what they can do is they can, if suppose a bank is in trouble, they can as a lender of last resort, they can actually, keep doing keep lending them through, by increasing the bank reserves, essentially. And that's a loan from the Reserve Bank to the, to the bank. Now, you also spoke about, the banks borrowing from other banks. That happens in the interbank market, and it happens, once in 2 weeks, when the Reserve Bank of India actually checks whether you have kept enough reserves. So let's say I'm ICICI Bank. I have let's say 1 lakh crore, let's say 1 trillion, so 1 lakh crore of deposits. If I have 1 lakh crore of deposits, I should be keeping 4,000 crores as essentially as reserves.
Yeah.
But suppose in the particular fortnight where when the checking is done, I have only 3,800 crores of reserve, let's say. So what I'm short by 200 crores. So what do? I basically go and look at go into the interbank market. And there might be some other bank, maybe it is SBI, which actually has 200 crore more of reserves, or maybe more than 200 crores. So I borrow that from them, and therefore fulfill my requirement of 4,000 crores. That is what is the interbank transactions that happens every fortnight, in order to satisfy the reserve requirements that to summarize, therefore, banks can borrow and lend among themselves, to satisfy the reserve requirements. Banks can, access the deposit insurance, which is insurance that they've actually taken, with the Deposit Insurance Corporation of India. And, if both of these fail, then you have the central bank as the lender of last resort. And the lender of last resort is, the central bank is called the lender of last resort because, it can indeed actually, if required, like a money tap can take care of, the banks. And that is why, and that privilege, therefore, is given only to banks that have the license. That is not the case with NBFCs, for instance. NBFCs will not have, that particular function.
Got it. And you think it is not fair to, let's say, give these licenses to NBFCs or even independent lending organizations, because despite they can sort of get into this interbanking system and just sort of keep raising debts to maintain their reserves, but you think it's not sustainable?
No, as long as they actually satisfy the requirements of a banking license, which includes the net worth above a certain threshold. Yeah. And also, there are basically this fit and proper criteria, all the requirements that a banking license requires. For instance, I'll give you the example of Bandhan Bank. I was on the board of Bandhan Bank. Bandhan Bank was an NBFC, and then converted in 2015. Bandhan Bank converted into a bank by satisfying the requirements for being a bank. So that's something which is which can happen, but you have to satisfy the necessary requirements to be a bank.
Got it. Now, since central banks, being the lender of last resort, have this sort of power to be like the money tap and infinitely provide money or assets to banks or provide reserves to banks. Do you think this is pretty much the case because the lower bounds are positive? Do you think this would also be the case if, as an economy, because the lower bounds are positive? If we went to a negative interest rate as an economy, do you think this would still be the scenario?
That shouldn't affect, because this is essentially, So let's not confuse the quantity and the price here, right? What you're talking about, the interest rate is essentially the price of money.
Right.
That's what the lender of last resort function is essentially, is I'm talking about the quantity. Any amount that the bank needs, actually, a reserve bank can provide. And of course, money is available at a cost. If it is, for instance, if it is negative, so even if, let's say, in the economy interest rates are negative, it may be the case that that particular bank will have to pay still a positive interest rate because of the combination of the risk premium. If the bank is indeed essentially in trouble, let's say, there is risk, of course, and therefore there may be a risk premium that might get charged. At the same time, also, there might be a distress premium as well. So it's, that is just the price of money. One of the things economists always actually say, money is always available, but at a price. So the lender of last resort function, basically the central bank is saying money is definitely available, but the price is something that will actually be determined by the market. And so let's not confuse the two here. Even in a economy where there are negative interest rates, positive interest rates, or excessively. So for instance, you take the Turkish economy today. The Turkish economy, inflation is like 70%. Obviously interest rates are very high, but even there, the Turkish central bank essentially will be the lender of last resort. Or if you take, let's say, Japan, for instance, where there were negative real interest rates, there again, the Japanese central bank is the lender of last resort. So let's not confuse, the price of money with basically the lender of last resort function.
Got it. So when we say money is a zero-sum game, and maybe rightly so, how exactly does wealth increase? Now, I understand you might tell that national wealth increases, let's say, when the amount of labor productivity increases, or if the amount of net capital in the country increases, or if, let's say, totally net exports is greater than net imports. There are multiple ways in which, let's say, a national wealth can increase. But from a global standpoint, do you think global wealth is also a zero-sum game? But clearly not. We've been seeing global wealth increases year on year. So how does global wealth increase?
No, you are confusing the viewers a lot by mixing up apples and oranges here. Let's make sure. See, wealth is different. I'll come to it. But let's understand first money as a zero-sum game. There's a difference between money and wealth.
Sure.
They're two completely different concepts. Money is different. Output in an economy is different. Wealth is different. Wealth is a stock variable. Output essentially in the economy is a flow variable. GDP is flow. And when we are talking about money, money is essentially not necessarily output. Money can be used to generate output. Now, the zero-sum game that we are talking about is only in the context of money. The title of the book is Money, a Zero-Sum Game. It doesn't say output a zero-sum game. It does not say wealth a zero-sum game. I think let's be very clear about that.
Sure.
It is only money a zero-sum game. And why is money a zero-sum game? Because as I explained, there are only three kinds of money in any economy. Currency, which is an IOU from the central bank. Deposits, which are IOUs from the commercial banks. And reserves, which are essentially IOUs from the central bank to the banks. Now, as I explained to you, because it's an IOU, every asset also creates a liability. When, for instance, the central bank, the governor signs a 2,000 rupee note, there is an asset that's been created in my pocket when I have that 2,000 rupee note, but it also has created liability for the central bank, a 2,000 rupee central, liability. Same way with bank deposits. When banks basically are depositing, a lakh into my account, there is an asset for me of 1 lakh, which is a deposit, but there's a liability for the bank of 1 lakh, which is what they owe. When a bank reserve, let's say, again, suppose, let's say, 1 lakh crore of reserve is essentially, let's say, as SBI holds with RBI, then, it is a 1 lakh crore, liability for Reserve Bank of India, 1 lakh crore asset for the, for SBI. And this is why it is actually, money is an IOU in contrast to, money is a financial asset, and therefore it's an IOU because every financial asset is an IOU in contrast to a physical asset. If you take the house that you have, it's an asset for you. but it is not, a liability for anybody else. In contrast, the housing loan that you might have taken to buy the house, that's a financial asset. It is a liability for you. It's an asset for the bank. And that is why it is very important to understand money is a zero-sum game, because when you start aggregating all these assets and liabilities at the macro level, what happens? Eventually all assets and liabilities will cancel out, right? Because every asset is creating an equal and opposite liability. And that is why we use the concept of the Newton's third law of motion for financial assets. What the Newton's third law of motion says is every action has an equal and opposite reaction. Here, that action of creating an asset or a liability has an equal and opposite, which is equal amount, but opposite if it is an asset, it creates a liability for the other entity. If it's a liability, it creates an asset for the other entity. And that is why it's an equal and opposite reaction, like the Newton's third law of motion. So this is the Newton's third law of motion in action for money. And that is why it is zero sum when you aggregate it across the, so just to, I think, illustrate even better, suppose the economy is comprised of only two of us, you and I, let's say, right? Now, we may do a bunch of transactions, using money. You may pay me, I may pay you back. But eventually what happens is, you have, I owe you something or you owe me something, right? That is basically what, when we go and net it up together, it is just a transfer between you and me. It completely nets out, zero sum. That's the idea of, macroeconomies. You're aggregating across all individuals, across all corporations, across all banks, central bank, government, all of them. When you aggregate, because every asset is also creates an equal and opposite liability, the assets and liabilities have to cancel out. So that is essentially it's zero sum.
Got it. I understood that. And I thought we'd established that money is a zero-sum game. But as an extension to that is what I'm asking. Yeah. While we understand that money is a zero-sum game, we understand that global wealth is not a zero-sum game. It's something that increases year on year. So how is it
even
that
output is even output is not a zero-sum game? And let me explain that now.
Sure.
How does the linkage from money to output happen, and then of course from output to wealth, I'll that I think is easier to understand. See, there is this theoretical relationship which is called the quantity theory of money, which is essentially nothing but MV is equal to PY. So M is essentially the the total money supply in the economy. V is the velocity of money. Velocity is basically how fast it moves, essentially. And P is the price and Y is the output in real terms. So, P is the price, Y is the real term, output in real terms. So PY is essentially the nominal output. And, the money supply times the velocity is essentially the money is in nominal terms. Now, this, if you can think about, see the equation. MV is essentially the monetary side of the economy, money times the velocity of money, and P times Y is essentially the real side of the economy.
Yeah.
So now this is where if you have, let's say, output increasing, in the economy, why do central banks typically will, look to create, money, and banks will also do this. So when output increases, what happens? Many borrowers are credit worthy because they're actually their output, has increased, that, demand is increasing. So banks will lend, right? Because demand for credit increases, and people are also more credit worthy because output has increased. So banks will lend. When banks lend, money is created. At the same time, the central bank will also, increase the currency in circulation, because, when output increases, in order to buy that output, there will be, money that is required. And so you have essentially, so if let's say the velocity of money does not change very much, it's sort of a much more stable. So let's ignore that, for this discussion. So if you have nominal output, changing by, let's say, 10%, and your money supply also changes commensurately, keep into account the velocity. It may not be exactly 10%, it may be, but it has to change in such a way that this identity remains the same. Then what you will have is that the price, your P, does not change, If real output changes by 10% and let's say money changes commensurately, then there won't be inflation because there is, your price does not change. But if suppose, let's say the output increases significantly, money supply does not increase commensurately, then what you'll have is you'll basically have inflation because you have too little money chasing too much of output. And the reverse is if you have too less of output and you have too much of
money in circulation.
If you have too much of money chasing too little of output, then you'll have inflation. If you have too little of money chasing, too much of output, you have deflation. And that's how the monetary side of the economy and the real side of the economy get linked through this, this quantity theory of money. So that essentially tells you how money gets created into output. Now, as I said, output is not zero sum, because if, for instance, and let's just take two examples. Suppose I give a loan, I'm a bank, I give a loan to Vijay Mallya, who does not repay the money back at all. What happens? This was a 5-year loan. So when the loan was given 5 years back, obviously money supply increased. Remember, loans create deposits, and therefore, whatever 10,000 crores or basically increase, now that 10,000 crores, was basically not put into good projects at all. So essentially the 10,000 crores is down the drain. No output got created. So what happened? Your money supply essentially increased, but there was no commensurate output, and that leads to inflation. Yeah. But on the other hand, let's say that 10,000 crores was, let's say, given to 10,000 individuals, 10,000 entrepreneurs, each of whom got a loan of 1 crore, and all of them essentially put that 1 crore, and just for simplicity, let's say they actually generated output of 2 crores. Whatever projects they put in, they got some maybe basically startups, some may be doing manufacturing, whatever it is, but these are all, let's say, good projects. So what you have now is you have essentially that 10,000 crores given to 10,000 entrepreneurs through 1 crore loans has created output of 20,000 crores.
Right.
Now, here you actually have, you can, if for instance, let's say the money supply does not grow adequately, you may have even deflation in the economy. But typically the, banks will lend more to these entrepreneurs. Save entrepreneurs, they'll come back for more lending, and they were given 1 crore loans. Now the bank will be willing to give them maybe 2.5 crores, 3 crores, and that increases money supply. So that's how you don't see deflation in the economy, because the central bank and the banking sector together will respond to output creation in the economy, and that's how you basically have. But if suppose banks, and that can happen where banks, let's say, say that for whatever reason, some exogenous reason, they don't lend at all, output has increased, but banks are not lending, you will have, you will have inflation,
deflation.
So you'll have deflation because you have too little, too little money, chasing too much output.
Got it. And how does this entire dynamics of, let's say, money and output on either ends affect how global wealth is created?
So see, as I said, wealth is a stock, right? So let me use a simple parallel. So every year you earn some income, right? Mm-hmm. That is a flow, much like GDP, right? Now, and as you so suppose, let's say, some part of it you don't spend, right? When you spend, the money goes out of you. It basically goes to somebody else, right? So as you suppose you keep saving, let's say your income is, let's say, 10 lakhs a year, and suppose you save 20% of that every year. So in your first year, when you started working, at the end of the year you had wealth of 2 lakhs. And let's say that 2 lakhs you put it into some stocks or whatever, some assets, etc., which also appreciates in value. So next year you have saved 2 lakhs. At the same time, let's say the 2 lakhs has become 3 lakhs, because of the investment that you did, interest income, capital gains, dividend income, etc. So you have now wealth of 5 lakhs. The 2 lakhs, that addition, from the savings, together with the 3 lakhs that you got as as a result of the investment of your savings. So as you can see, the 5 lakhs might next year then become, might become, 12 lakhs and so on. That is how. So wealth is essentially the stock, while income that you get is essentially the flow. In a similar way, at the national level, GDP is essentially the amount of activity or amount of output that has happened in the economy in that year, and therefore it is the flow. At the national level, wealth is not measured because it's very hard to measure. You'll have to account for every asset, in the world. To be able to, and that might also include some paintings, for instance, which where the price may be very hard to determine. You may think that particular some paint that is just thrown on a piece of canvas, you think that is worth $1 million. I think it is worth trash. I think basically it's worth zero. And that may be possible. So therefore it's very hard to actually sort of measure wealth in the economy. But but output, you do actually measure using GDP.
So maybe taking a step back, when we were discussing how banks deal with money, when we're talking of currency being mostly physical today, although we might, let's say, make electronic payments, I might use UPI or do IMPS or NEFT payments. At the end of the day, we see that banks amongst themselves settle money physically. Money is taken from one bank to another. Or is it? Am I wrong in telling that? How do settlements happen today?
Settlements all happen electronically. Who takes basically money in gunny bags and settles? No. It's all completely electronic.
Got it. And if that is also the case with cross-border exchanges or cross-border transactions, why is it that we lose out so much of percentage to the entities that play in between?
Because they charge essentially fees for intermediation. So it is as if, think about, nowadays we have these, apps in India, right? Who, let's say I forget the name of the app, but suppose I want a book delivered to you. You are somewhere, in the city of Hyderabad itself, I want to deliver, let's say, right? I'm in Gachibowli, let's say you are in Dilsukh Nagar, and I can send it. The person who's basically, carrying that parcel charges. Or if you take FedEx, for instance, I send some stuff from here now in Washington, DC to, let's say, my family in Hyderabad, and FedEx charges basically because it's the intermediary carrying the parcel. It's the same thing, the intermediary that is basically carrying the parcel of money. I'm remitting, let's say, some money to my, my family back in Hyderabad. The bank or let's say, Western Union, intermediaries who are just passing the parcel, and they're charging for passing the parcel. Now, what happens is when you have a competition where you can have up until several years back, the Western Union or the SWIFT, etc., those were basically were effective monopolies, and therefore they were actually charging very high for passing the parcel. But when you have now things like UPI and digital payments that can be done through online, then there is competition. So obviously they will have to in order to stay in business, they'll have to reduce the price of passing the parcel. Effectively, what these when you take cross-border payments, it is nothing but passing the parcel. That's all that is happening. And these intermediaries are essentially just they are like FedEx, and they're charging price for basically passing the parcel. FedEx is passing a physical parcel. These the Western Unions or the banks are essentially passing the money
electronic parcel. And
the money parcel.
The money parcel, and this parcel that's being passed on is just electronic.
It's just electronic, absolutely.
Then you think they could do away with much lesser, parcel transfer fees as well?
Oh yeah, that's why competition is important. I think one of the fundamental principles that economics teaches is that competition reduces price. for the consumer. The consumer, when you have a monopoly, which is what a Western Union has been, then obviously they can charge very high for passing the parcel. But if you have other means of electronic payments that you can do, then in order to stay in business, they have to actually reduce because a new entrant, what will the new entrant do? New entrant, in order to attract business, will charge a lower price. But then for Western Unions to not continue to bleed and lose business, they'll have to reduce the price as well. That is how actually this thing functions.
Got it. And this might be a naive question, but I want to ask this anyway. So if we, hypothetically conceive something like a global neobank, let's say, and I want to allow, let's say, a transaction from India, I, Krishna, am, sending you $10,000.
So what is a neobank? What is a neobank?
Basically, no physical presence.
Okay. Yeah.
Just a bank that has.
Online bank.
Yeah, just online an online bank. So, and let's say I am sending you $10,000 and you are in the US and I'm in India. Now, one of the biggest concerns with setting up, let's say, these global neobanks is, okay, although I might send you the money in rupees and I will have to do it just in rupees because I do not have dollars, this global neobank will have to do, I'm not sure how, but they'll have to do a certain currency exchange. And typically, it's not going to be complex because there's no physical tender happening. It's all just electronic. So you can always convert it to an equivalent dollar amount. And then a certain dollar amount is going to be credited in, let's say, your account with the same neobank. But then the challenge we face with global neobanks is how do you do withdrawal? How do you withdraw the money from your account? Should this global neobank have physical reserves for you to be able to do the withdrawal?
No, actually, so that's not the challenge because when so much of transactions are happening happening just through digital money, you don't need physical withdrawals. For instance, let's say I am sending dollars to you, and in India, for instance, you can, even if you want to go and buy fruits, let's say 50 rupees, you want to buy a dozen bananas. You can pay using Paytm to the fruit seller, right? So because you're doing a digital transaction, you don't need to go to the ATM, and withdraw money to be able to pay. So when you think about push to its limit, in the United States as well, there's a lot of digital transactions you can do. So that's not the challenge. With a neobank, it's not the fact that they have to have physical locations. The challenge is who will regulate them. As I said, I go back to my very first point, which was that Tom, Dick, and Harry cannot create a bank because they have to have net worth, they have to be regulated because they are taking deposits, right? They're taking deposits from people, that's other people's money. So this neobank, should it be, if for instance there is a global banking sector regulator that's created, like a central bank of the world, something like that, just one can think conceptually, which regulates all these neobanks that operate across the world, then it might be fine. Right now, how does this get done? If there's a Citibank basically creates a subsidiary, Indian subsidiary in India, and that Indian subsidiary of Citibank is basically regulated by the Reserve Bank of India. The Brazilian subsidiary of Citibank is actually regulated by the Brazilian central bank, and so on. That's how the regulation right now happens. But there could be if you have just a neobank doing digital, money could move very fast, and the regulators may not be able to coordinate, and that may become then conduits for money laundering, tax evasion, etc. And that is basically the problem with these neobanks. So I think if there can be, at least hypothetically, a central bank of the world or a global central bank that can regulate these neobanks that operate across and move money very quickly, then I think that that idea might actually might become feasible. But at this point in time, actually, it is a regulation. It is not the physical branches.
Got it. And when you're talking of, let's say, this hypothetical central bank of the world, are you conceptualizing a single currency that is used globally, or do countries still continue to use multiple currencies?
No need for, actually, that's not required at all. Even today, for instance, you have, what do you think about it? Basically, currencies are those are just exchange rates, right? Which is, a dollar is, exchange it for 80 rupees. Those can continue. That is not required at all. As I said, I think neither the physical branches nor the necessity of one currency is a challenge for the creation of neobanks. It is actually the regulation and the supervision of these banks. If these banks start lending as well, so there's a neobank, let's say, no physical branch, starts giving lending to, lends to, let's say, some equivalent of Osama bin Laden, sitting in Pakistan. How do you regulate that? And or let's say a drug warlord somewhere in Colombia or somewhere else, right? How do you regulate those? That's the big challenge. You can have a lot of nefarious activities happening, through these neobanks if they're not regulated and supervised properly.
Got it. So since you mentioned that currencies are nothing more than exchange values, then I understand there might have been merits for different currencies because the denominations and what you can purchase with different denominations vary in different countries. But when we are, let's say, as a world resorting to mostly digital transactions, where denomination might not be the biggest concern because you just have to type in a certain number, do you think there is still any merit for countries to have different currencies?
Absolutely. The reason, so for instance, if you have to pay taxes in India, you can pay taxes only in rupees. You can't basically, say, oh, I have dollars with me, I'll pay taxes in dollars. No, the Indian government will take, its tax payment only in rupees. Similarly, the United States government, you have to pay taxes to them. You can't say, okay, I have rupees, take rupees. They'll say, that's not our problem. You convert it into dollars and give it to us in dollars. Tax payments in every sovereign, in every country are actually made in the, in the currency of that sovereign. If let's say, sovereigns start accepting, saying, oh, we will take taxes in some global currency, right? That which is a fantastic thought, but it is fantastic because it's unreal at this point. Till such time, I think this concept of a global currency, etc., is a non-starter.
Got it. But although it's not realistic, but you think if for any reason, if let's say countries come together and sort of agree upon something, you think?
I think that's. I don't think we should be even wasting our time on thinking about this, because you have countries going to war at this time actually, and distrust among countries increasing. I think that's just a completely utopian thought.
Got it. And do you have any thoughts on cryptocurrencies as such?
Yes. So I think many people oftentimes fail to make a distinction between CBDC and crypto assets. CBDC, central bank digital currency, and it is no different from the actual physical currency in rupees, except that the rupees, let's say 2,000 rupee note, is a physical IOU from the central bank from India. 2000 CBDC basically will just be a digital IOU, again, backed by the Central Bank of India, by the Central Bank in India, or the Reserve Bank of India, essentially. So when I say I don't mean Central Bank of India, I mean Reserve Bank of Central Banks, in India, which is basically the Reserve Bank. So that's what CBDC is. It has the feature of a deposit. When you're, when you keep, let's say, 1 lakh rupees with a bank, it is just a digital money that you have. But it is issued by, it's a liability of the Reserve Bank of India. That is what central bank digital currencies are. Crypto assets are essentially built on blockchains, and that is, I think there is a presentation that I have on LinkedIn, because it's a much deeper concept. I think it'll take time to explain it. All I will say is that we should not, confuse the digital, the central bank digital currency with a crypto asset. Crypto assets basically, as they say, it's they have what are called public and private keys, in order to actually open the. So there are nuances which I think it's best to take a look at the presentation. The LinkedIn presentation has all these details.
Got it. So when we say that a CBDC is nothing but an electronic version of, let's just say, 1 rupee equivalent of that, and if CBDCs were significantly separated from having an affiliation with blockchains. Why do you think have nations of the world not yet come up with their CBDCs, and why is it not prevalent yet?
Because of security reasons. It could there could be when you issue physical currency itself, right? You have to take a lot of care to ensure that there is no counterfeit currency.
Sure.
What you don't want is a 2,000 rupee note that is counterfeit, that is actually generated by someone else. That power to actually issue that 2,000 rupee note is there only with the Reserve Bank of India. Now with digital money, that risk is even more. How do you? So if somebody let's say hacks into a central bank system, and then maybe issues a lot of money to itself, etc. There are lots of problems of security, essentially counterfeiting, that can happen, and that is, I think, the reason why central banks are actually moving slowly. But I think this will happen. It is important to make it happen. But I think all the necessary security aspects have to be have to be taken care of.
Got it. But when you say that security is the biggest challenge, don't you think the purpose of blockchains is to provide for this security and prevent counterfeiting? The way blockchains are built today, and I can understand why crypto assets are not the right way to go. But if you were to build, let's say, a CBDC as a stable coin on a blockchain, why do you think it is failing in terms of security?
No, see, so stable. Stable coins are that's different. It basically is typically what happens is with crypto assets, right? There is nothing physical that is essentially backing it, and therefore the value of that can oscillate any amount, right, depending on demand and supply. And what you're trying to do with a stable coin is assuring, saying whatever so it's like, suppose, let's say take some some crypto asset, the price of it, let's say today is 10 units of that crypto for one rupee, let's say, right? You want to create a stable coin, and so what you do is, let's say, you issue, let's say, 1/10 of that crypto, which essentially then translates into 1 rupee. So 1 unit of that is, let's say, 10 rupees. So now if the price changes, you change the units in such a way that the actual rupee amount remains 1 rupee. That is what in essence a stable coin is. Now, yes, blockchains are actually are useful. Because it's a distributed ledger, you actually can there is the trail, because there is essentially as the blockchain evolves, there is history of what the transactions that have happened. But what is important is, therefore, for central banks across the world to have that expertise to be able to dig into that history and find out what is going on, and that's non-trivial. It's not actually something that is anybody's game. And so I think central banks, in my opinion, are evolving these to be able to because yes, the history is there, but if you can't go and search for that history and find out the right things, well, then you don't have the power to be able to regulate and supervise well, right?
Can you elaborate on that last part? What do you mean by go back and search? What exactly do you want to search?
So for instance, is there something else I can help with? Sorry. So as we know, the whole point of crypto, because it's a blockchain, every time there is basically, the way when the block gets created, right? When a block gets added, there is that, what has happened in that history is completely, that trail is there.
Right.
Now, if suppose suppose that money trail is being used for nefarious activities, right? At some part of the blockchain, some corruption happened. When I said corruption in its use, suppose it is getting used for, let's say, for drugs
Dealing with
or
drugs,
terrorism or whatever, right? Now, in a large blockchain, and I'm just explaining conceptually here, in that large blockchain, the central bank has to have the ability to basically search, ferret out where is that corruption, quote unquote corruption that has happened, and thereby then trace it out, saying who did it, right? Because eventually, you can't let it be laissez-faire. If it is laissez-faire, a lot of nefarious elements will actually use it for all wrong purposes, and that will be harmful to society. So that's what I'm talking about. That ability to continue, and because these can happen very quickly, in a minute of matter of just seconds, right? Things can. So you have to have the ability to be able to sort of, that's what I mean by tracking that history and finding out it, ferreting out. It's like sometimes it can be like searching for a needle in a haystack, and that ability to be able to search for the smallest needle in a haystack. It may, the needle may seem small, but the amount that may have gotten transferred, or the ability for that needle to poke and really create havoc, may be very large.
Got it. Please correct me if I'm wrong, but don't you think, although it's fairly complex to scrape through the blocks and the transaction history and identify which of these might be anomalous or might be linked to any corrupted activity, but in the physical world, when transactions are happening, let's say with physical money, most of drug dealing, or let's say any illicit activity happens physically, there's no scope of even chancing upon any of the finding an evidence that this happened. But at least in the world of blockchain, although it's complex, at least you have a possibility of using that transaction as a proof that something actually happened.
No, I hear these from from those that are actually blown away by technology. I'm an engineer myself. Right. When I was a CA, many of my former students would keep basically sending me emails, exactly talking about the C. What you have to understand is just the physical activity of having to, take out money, and then transfer it, that actually slows down the process significantly. And also, there are, for instance, there is, when you're transferring in every country, there is police that, if there's some suspicious activity, they'll check, they'll say, show me what you have, if you're carrying, let's say, bags of money, right? They'll catch you. Customs, for instance, on ports, basically, if you're bringing in bagfuls of money, the customs will physically stop you. There are these, our society has built in these physical checks and balances to basically stop nefarious activities, and that slows it down. And just the aspect of having to take out money physically, transfer it. If you have to transfer money, let's say I have to transfer from, let's say it has to be transferred from Pakistan, let's say to Colombia, right? It'll take 2 weeks for it to happen physically, and there will be checks and balances at possibly the Pakistani border, Pakistani airport, then in the wherever Colombian border, those are all, and none of that actually is there when you do with with digital, and it can happen in seconds, microseconds. So that's the fact that it basically takes 15 days for this to happen also gives the regulator the time to be able to track it and stop it, and which is not there with crypto. So I actually am quite sympathetic to all these the fans of cryptos, etc. actually, who say, oh, but you have to I think such fans have to get real and say that that there are the ability to create havoc, because of the lack of these physical checks and balances, and the entire, in some sense, slowing down of this, just the physicality of that process actually slows it down, and thereby gives the ability for the, for the regulator and the authorities to basically supervise it. In some, when you think about when you think about nefarious activities, it is essentially a cat and mouse game, right? The mouse, what physicality does is essentially slows down the mouse, to some extent, so that the cat can keep a watch on the mouse. With basically or completely online, the mouse can move like lightning speed, and you have the cat still moving at its normal speed. So there's no way that the cat can keep a track on the mouse, and that is the basic problem.
Interesting. That's a very unique perspective. I myself am very cynical about crypto, but I'd never thought about it from this perspective, that like having physical checks and balances actually slows down the process of crimes. That's a very unique perspective.
Slows down, but thereby also actually enables some hurdles to be created. I mean, it's like, for instance, if you think about people when they have to, let's say, get money or drugs or whatever, they have to when they have to smuggle it in, they have to use such creative ways, right? And because the hurdles are so high, you're going to get caught. What happens is with if it is crypto, those hurdles, etc., just go down almost to zero. So it can be done very, very easily, and that is so I think the physicality of it actually ensures that there are many checks that is happening. It's as if, let's say, I'm going from point X to point Y. But while going from point X to point Y, there are many gates where I've checked essentially, and those gates, and the fact that because I'm actually walking, if I am doing something wrong, the police authorities can run and can sort of catch me. But if I'm going at lightning speed with no checks in between, no gates in between to check, there is no way of clamping this down.
Got it. So maybe just switching tracks here. How's your day as an executive director at IMF? What does it typically comprise of? Just curious to know.
Well, so I think let's understand the activities that an executive director has to do, or the board. So executive director is part of the IMF board. So there are about 200 countries that are part of the IMF. And one of the key functions that the IMF does is country level surveillance. Surveillance of basically the macro fiscal situation. Every country's macro fiscal situation is presented through what is called Article 4. It's essentially the Article 4 in the Articles of Association, which is essentially just the surveillance activity. So when, let's say, surveillance is done on India, then India's Article 4 is essentially, as part of Article 4 consultations, India's macro situation is presented to the board. Now, so like India, all the other countries, the 200 countries, Article 4s essentially get presented through the year, because it happens all through the year. So now, just think about it. So there are 252 working days, 200 days essentially for, at least 200 board meetings for the surveillance activities. That's one of the key things. So, and each board meeting on surveillance on average can go for an hour and a half to 2 hours. Apart from that, then there is actually, there is the countries requesting for aid. So for instance, if you look at, in our neighborhood in India, you have Bangladesh, Sri Lanka, and now Pakistan as well asking for aid. And when the aid package is basically requested, it has to be studied. It gets presented in the board. The board will basically then opine on it, either approve it or disapprove it. So that's another set of of basically board meetings. But as you can see, the board before the actual board meeting, you have to prepare, study for it. So so for instance, in the case of the surveillance, there'll be country reports that will be written, and those reports have to be actually looked at. You have to critically examine it, give your views on it. Similarly, then on the aid programs as well, again, before any aid program, there'll be a report that will be written by the IMF staff. You have to go through it, give your opinion. So that's all the background stuff. But the actual front, sort of front end is in the form of these board meetings. So the surveillance, activities and the aid packages And then apart from that, then IMF policies and broad, agenda setting, etc. So these are all the main activities that IMF undertakes. Of course, there is capacity development as well that IMF does. So all these then get come to the board, because the board is the ultimate sort of decision making authority of the IMF. ED's activities are some basically of all these activities.
Very interesting. Quite a happening life, I would say. Quite interesting.
I don't like these. I don't like these words, happening, etc. I when I was a professor as well, for the outside world, it doesn't seem like it's happening, but it is. What is happening or not is actually what you feel internally.
Wow. Okay. Interesting. But just a question, since you mentioned IMF also deals with giving aid to nations on request. How exactly are these aids created and processed? Like, where does the resources for the aids come from?
The resources come from, basically, IMF has been created by contributions from member countries. IMF basically has these contributions, and those contributions are used to give aid to these countries.
So it's almost just out of goodwill, and the nations who are actually giving those resources do not have anything to gain from it.
Well, I think it's more than goodwill. It is actually also to ensure that the international economy, the global economy, and the international financial system remain stable. Because if you have, suppose, let's say, one country defaults, some other country may have lent to that country. There may be a cascading effect, and it's not just goodwill. It is actually to ensure that it's like forest fire, right? When there is a forest fire, what do? You basically try to limit the damage by saying that suppose fire is burning, let's say, at this place. You say we want to ensure that it doesn't burn the entire forest, and we want to limit the damage, and a lot of these aid packages are essentially intended to sort of stop that fire from burning the rest of the world economy.
Got it. And since we are in the budget week, any thoughts on the recent budget that was announced in India?
I actually, I wrote a piece in the Times that came out yesterday.
I read it, but just wondering if you had anything to share to the viewers.
So I think it's an excellent budget. The most important thing is how it resisted the temptation of populism. I'm going to contrast it with couple of budgets of the previous government. So take the 2008 budget, which was the budget before the 2009 elections. The government then announced an 85,000 crore farm loan waiver, which was basically 2% of GDP, of the country's GDP, 2% of country's GDP. In other words, what the fiscal deficit, whatever I forget the fiscal deficit number, but of that fiscal deficit number, just 2% of that. Suppose the fiscal deficit, let's say, was 5.5 or 6%. So of the 5.5 or 6%, 2% just came from this farm loan waiver. And I have a paper showing that was just cornered by rich farmers. This was just quote unquote clear populism. And you then if you take the 2013 budget before the 2014 elections, the National Food Security Act was passed, and it was when I used to work in North Block, it was basically mentioned as the budget to essentially bring the incumbent government back into power. This was called as the move, NFSA, National Food Security Act, as basically the ticket for the government to come back to power. That's how. But it created a huge amount of food subsidy. Increase the food subsidy hugely, because 75% of the rural population had to be given, rice and wheat at 1 rupees or 2 rupees, and 50% of the urban population also, at the same price. It created a huge amount of subsidy. That is again basically revenue. So if you take the 2008 budget, the farm loan waiver is revenue. The 2013 budget, the NFSA is also revenue. And it translated into fiscal terms, that's just pure revenue expenditure that does not create any assets in the economy. In contrast, take a look at this year's budget. The capital expenditure has actually been increased by 33%, and it is 10 lakh crores, by far the highest, in our 75-year history. Add to that the incentives that have been given for states to do capital expenditures through the 50-year loans, which have to be, those loans have to be availed either this year or the next year. And that is 3.7 lakh crores. So in aggregate, 13.7 lakh crores, which is essentially 4.5% of the country's GDP in capital expenditures. And when you look at the actual subsidy amounts, that's the revenue expenditure. Subsidies, net subsidies have decreased 28%. 28%, and the food subsidy, fertilizer subsidy, both of those have declined by about 30%, or in excess of 30%. And that's how revenue expenditure has actually been decreased, or revenue distribution essentially has decreased by 28%, while capital expenditure, which actually creates assets in the economy, has gone up by 33%. Just look at the contrast in terms of and I say this because a lot of the ecosystem that is sympathetic to the previous government keeps saying that that government basically knew its economics, or there were people basically sort of reputation, but look at who basically just talks economics, and who walks the talk on economics. I think it's any economist worth his or her salt will definitely say that creating assets is far better way of spending the taxpayers' money than just distributing it, and that too not distributing it to the really needy. Because we know very well, in the NFSA, there used to be a lot of pilferage as well, and this did not reach the intended beneficiaries either. So I think, to me, the best part of the budget really is the fact that it is based on the principle that good economics can make for good politics. Up until I always was taught when I was learning economics in the Indian context that good economics does not make for good politics, and that is because of the kind of budgets that the 2008 to 2013 budgets were actually symbolic of this credo that was pushed, that good economics does not make for good politics. But I think this budget is based on the principle that good economics can make for good politics.
Got it. All right. So one point that you mentioned that really caught my attention was the amount of subsidies have really gone down, and why it's a part of good economics and why it makes up for good politics. But don't you think haters are going to just say that subsidies were the amount of benefits that were being given to people, and you've reduced that? Like, what is just your counter to that?
See, in economics, you can never, you would never have a 100 economist. There's always a trade-off. But as I said, when you create assets in the economy, that's a far better way of spending the taxpayers' money. Budget making, and having been involved, in 4 budgets, budget making is all about prioritization, because resources are always scarce. When you have, let's say, 100 rupees to spend, only 100 rupees to spend. The question is, do you want to, use that 100 rupees to just go and, let's say, eat, which is basically the equivalent of revenue expenditure, or do you want to go and create an asset with that 100 rupees? Obviously, when you create the asset, the earnings that you'll get out of that subsequently will be greater. When you go and, just eat that 100 rupees away, nothing is created for the future. So, budget making is all about prioritization. And when that prioritization is done well, as it has been done, in this case, I think, it is excellent. As for criticism, look, I was the chief economic advisor when the once in a century pandemic happened. And, we basically had to do the lockdown to save lives, which, because of the lockdown, there was a 24% decline in GDP. And, I went and handled the media and took a lot of criticism at that point in time. And when all the advanced economies were spending like there is no tomorrow, we decided to be very prudent. At that time, again, there was criticism that is leveled. I think, it's part of the KRA of a policymaker to be able to take criticism. A lot of the criticism is, I think, oftentimes empty rhetoric, and even some of the criticism that may not be empty rhetoric. You have to actually take that into account, because, as I said, prioritization. When you prioritize, you basically say, I will do these 3 things. I will not do these 17 other things, or which are not as important. I think there will be some criticism, but whether it is in life or in the economy, if you try to do 20 things at the same time, you get nothing done. But if you focus on, say, I will get these 3 things done, and I'll really focus my energies on these 3 things, because these are the 3 most important things, you actually have far more impact than when you try to do 20 things. Of course, when you try to do 20 things, you're ending up being a crowd pleaser, but you're not doing the right thing.
Got it. And one more thing that really stood out in this budget for me was the tax relief was increased up to 7 lakhs. That is, if your income is below 7 lakhs, you do not have to pay an income tax. Now, what does this really mean? Of course, for the people who have an income, they are waived off with the tax. It means something for them. But otherwise, from the economic standpoint, what does it mean? And more importantly, Professor Miles Kimball, who's an economist at University of Colorado Boulder, was previously on my podcast. And there we were talking about having an income-based taxation versus an expenditure-based taxation. That is, if you completely waive off income-based taxation and, let's say, just surge the taxes on goods and services, VAT and GST and stuff, depending on people's consumption, the tax they pay is going to change. So do you have any thoughts on what taxation system is better and why?
So, so you have asked me 2 questions here. Let me first respond to your first question. So the increase to 7 lakhs means that 1 crore individuals benefit. They will not have to, pay taxes. As for the economic impact, see, the finance minister mentioned this in a budget speech, that the impact of these tax cuts is 35,000 crore rupees. What is the revenue base of the total of the budget? Close to, it's almost 35 lakh crores. Okay, 35 lakh crores.
So 1 in 10.
Not even is about 1%. 1%. Not, and at the same time, so that's just the direct hit 1%, which is very small. But there is also the concept of Laffer's curve, Laffer curve, which is where decrease in tax rates actually, there's more money in the hands of people. The Laffer curve is about actually reduction in tax rate, and it sort of enhances people's incentives to not evade taxes, and thereby, tax revenues go up. But at the same time, there could also be an impact through consumption. There's more money in the hands of people. People consume more, and that, as a result of that, there is basically, GDP increases. Tax revenues increase through that as well. So these are both sources through which, some of that 35,000 crores can actually easily be, some or all of that 35,000 crores can be recouped. Can actually be recouped. So I don't think it's and whoever is basically criticizing this is obviously doesn't have their math right.
Right.
Now, as for income taxation versus let's say the taxation and expenditure. See, I myself I'm an academic who's then become a policy maker. as academics, we academics love to actually, think about these corner solutions. Corner solutions. Oh, zero income taxation. Or zero expenditure taxation. Those grab headlines. But I think the world of policy making is far more nuanced. You have to actually sort of in policy making, you don't have the luxury of being, of recommending something and then not having to bear the consequences of it. As a policy maker, you have to actually bear the consequences of the actions you take. Academics actually, and I've done that too. You can advise and say, but if that advice, let's say it turns out to be bad, you don't bear the consequences. Whoever is implementing that advice bears the consequences. So I think this is very important. Therefore, oftentimes academics will actually, come up with sort of fantastic utopian ideas. For instance, this, the idea of this universal basic income, a ridiculous idea, not practical at all, and but grabs headlines, and like that. There are other ideas that basically can be talked about by academics. The important point to understand here is, and you have to keep the political economy also in picture. Income taxes, especially in the Indian context, income taxes are paid by about, let's say, 6 lakh people, 6 crore people, in a population of 140 crore, while the expenditure tax is actually paid by almost everybody, because everybody consumes, right, on consumption, while essential items have much lower taxes, but there is some through expenditure taxes borne by everybody. So if you remove income tax, what are you doing? You're basically, the 6 crore people who clearly are far more privileged in a population of 140 crores. You are essentially, not making them, sort of take some of the burden of running the country. Instead, you're actually putting a lot of the burden on, the entire 140 crores. I think from an equity perspective, that does not make sense. These kind of considerations actually have to be kept in mind that's why the political economy is important as well. So I think these are utopian ideas that actually, that pure academics love to indulge in, but they're not practical.
Got it. And one last question, Professor. If you were to build a fintech, what do you think is one problem worth solving for?
Oh, there are several problems worth solving for. I think if fintech can just go and solve the problem of credit creation in the Indian economy, only 1 in 7 individuals in India actually gets credit. If fintech can go and actually make it even, 2 out of 7 or better, 3 out of 7 individuals, I think they would have done human service to the nation.
And how exactly would you go about increasing the number of people that can get credit?
Well, fintech can basically use there's so much of data now through account aggregators, the entire UPI transactions. Why can't basically a fintech go and say, let's say, they think about giving loans to that fruit seller I spoke about. The fruit seller now has, over the last year and a half, takes money through Paytm. He has the entire track record of how much is his earning. Suppose he earns, let's say, 30,000 rupees a month. So why can't the fintech go and basically give a loan to him, so that from the thela in which he's actually selling the fruits, he sets up a shop. And then once he sets up a shop, after that, give him credit, and thereby basically maybe becomes a fruit distributor, etc. So, I think the amount of data there is, that data can really be, can really be analyzed very well, can be mined to go and give credit to those sections of society that the banks don't lend to. And that is, I think, if fintech can just do that, rather than running after people like you and me, we actually, if we want credit, we can anyway go and get it from the bank. So, if fintech can just go and increase these, so as I said, 1 in 7 individuals basically in the country gets credit. So the 6 out of 7 individuals who don't have credit from the banking system, if they can even do 1 out of that 6, right? Half of that 6, make it 4 out of 7 individuals getting credit, I think they would have done a fantastic job. I think fintech doesn't need to do anything else, just do this bit, and they would have actually themselves made money for themselves, but at the same time also would have done great national service.
Got it. Got it. Thank you. Thanks a lot, Professor, for this conversation. I would say solid, insightful, but maybe repetitive for you. Apologies about that, but thank you. Thank you for spending time.